banking end. Jigar Mistry, the co-founder of Buoyant Capital, is now with us on the show. Jigar, if it wasn't for the big weakness in the IT names, perhaps markets would be trudging higher today. Not by a whole lot, but at least it would have had a green tick. And we've had a good run-up in the markets. Do you think the risk-reward is now favorable for Indian investors to go ahead and buy? Would you recommend buying this dip?
Yes, good morning, Rima. Thank you for inviting me to your show again. I think we are actually reacting a lot to the news. So if we take a slight step back and, just realize that federal banks, the sort of central banks around the world have not really stopped their action vis-a-vis the tightening part. Yes, obviously when they increase the interest rates, your economy slows down, etc. is all known. Investments move a lot more to stable currencies, and therefore FI outflows happen. That is known. But I think one of the less admired fact is the case that they keep trying until something breaks. In 2006, if you remember, they increased the rate to 5%, and then we had a full 20% rally on S&P before the global financial crisis happened. This time around, what they've done is that, they've contained the SVB and the signature crisis to a whole extent, and therefore the contagion has not been that pervasive, across the globe. In that backlog, if you look at India, in the last week of March, we had, a lot of people booking out tax losses, and therefore a lot of smaller mid-caps were down and out. But I think in the rally that we have seen, you've seen a reasonably smart move, both on the broader indices, but more so on the underlying basis. Now, if I look at the markets from here on, right, and you look at the big sectors, there is not that much to frankly cheer at the index level. Now, assuming that, foreign flows will continue to remain challenged. In that scenario, banking, we have discussed that in the past, the broader adjustments have largely happened. We'll see most of these banks report in line, or the share prices will move in line with earnings growth, which is, I would say, 12, 13, 15% or thereabouts. Tech until today was clearly sort of higher on the 5-year average basis. Now we will have to cope with the fact that it will be a single-digit year for the next couple of years at least. Oil and gas, hardly anything to cheer. Automobiles has not so much been, earnings story as much as it has been what we used to refer to as an embedded valuation story. So PE investors have chosen to spray and pray. And then, valuations have increased, earnings are not really flowing through as thick and fast. So the bigger sectors are not really suggesting a scenario where earnings growth will leave a lot of comfortable area to operate around. And therefore, I think the play will more or less be in and around the small mid-cap names, where, company specifics, they were, yes, marred by the complete lack of liquidity. And that seems to have eased out. And I think a lot of these companies, as you were mentioning initially, are coming off their own as we discuss this.
Jigar, hi. Good morning. Good to have your thoughts. The sector we definitely want to get your views on is IT, because there's this huge debate going on whether you need to buy now to make money and generate wealth, over the longer term, or whether this could be a painful, longish haul in terms of, when things start turning around for the IT sector. What's your view?
Yes, so yes, I'd say, the fundamental difference that a lot of us forgot was that India does not really have tech, right? What we have is IT services, and both are fundamentally different in their cash flow and the ability to report very strong growth in numbers. With that in the backdrop, right, there was very little scenario or case to be made where, the valuations for IT companies in India expanded in line with NASDAQ, right? And obviously in 2022, they sort of corrected alongside them. There was no reason for them to go up and now for them to correct. In this sort of backdrop, and therefore 5-year average is sort of skewed because it had a good 2 years plus of something that at least our estimate should not have transpired. You take a slightly longer term view and look at the averages before that in a growth scenario, which was a lot more conducive. We did see multiples that were lower than what IT companies are reporting or, are trading at today. And with that in the backdrop, it's difficult to make a case of aggressively going ahead and buying. There are a lot of these smaller IT companies which are niche businesses, which may make some sense or the other. The ones that we own is a company called Cyient. I don't track IT very closely. Viral from our team does, but from what we understand, they still have a reasonably good backlog. Yes, overnight the positive that has happened is a few banking numbers, JP Morgan, etc., were reasonably okay, and BFSI is a large exposure. So we are not rushing into buying IT just yet. There will be opportunities if the growth sort of span clears out. Then we may, take a fresher call, but no hurry, so to speak.
Okay, that is on IT. Jigar, very quickly, any thoughts on the banks? We did have HDFC, which has, been a little bit forgotten because of what's going down with the IT pack right now. But thoughts on the banking names?
Yes, Pavitra. So, the last time around, we did discuss that if you look at the 4 cycles of banking, the credit growth cycle, the NIM cycle, the credit cost cycle, and valuation cycle, I think we are fairly sort of there across in all of them. Credit growth has been reasonably okay. In that aspect, I think one needs to, keep this in mind that the difference between GSEC and Fed fund target rate at 150 basis points is the lowest we have seen in 23 years, right? And we have $280 billion of maturities, short-term maturities coming up in the next 9 months or so. So if part of that gets refinanced from India, then you could still have a reasonably strong and kicking credit growth cycle playing through. NIM cycle typically, peaks out once your interest rate hike peaks, and because banks tend to sort of reprice assets much faster than liabilities, and therefore NIMs expand when interest rates are rising, and obviously that becomes true when interest rates fall as well. So we might be at the peak of NIMs. It will again be a bank-specific issue, but broadly NIMs won't expand here, but they won't correct dramatically. Credit cost, which is the third cycle, I think has been holding out pretty well. For most banks, incremental growth has been led by retail for the past 5 years at least, and those don't sort of blow up en masse, and therefore you'll not see a credit cost which is worsening. And lastly, valuation is one cycle which got played out very well, differently. So over the past 3 years, I would say the discount between an ICICI versus an HDFC bank, which was almost 70% at the peak, narrowed to something like 10-12% right now. If you include HDFC Bank consolidated, then it's as low as 3%. So I think all these things have played out, and a few investors who were brave enough even played this through PSU banks, and that has played out. From here on, if you look at HDFC Bank's numbers, I think the only disappointment has been in the revenue expenditure part, and they are actually opening up branches pretty fast, and that will eventually come up to play. So if I look at a correlation of share prices to say something like an NPL vis-a-vis say a RevX, I think the correlation to share price is much lower for RevX, and therefore it's not a huge case of worry regardless. This bank is now attracting something like 20% of incremental deposit, 1.5 lakh crores. That's a huge number. And eventually they'll go out. I understand that's because part of it is merger related, but eventually they'll create a slate which they can lend against, and therefore it makes a very strong case for this bank to start gaining its exposure again, and start claiming its top spot.
Got it.
Yeah.
Jigar, we are unfortunately running out of time, so we'll have to wrap it up for today. But thank you very much for your thoughts and views. We'll take a quick break. On that note, more on the markets on the other side.